Welcome to the Explainer. Let me ask you a question. Do you honestly think the financial markets are a fair playing field? Like when you place a trade, do you really have the exact same shot as the Wall Street heavyweights? Well, think again. Today, we're exposing a harsh, totally data-backed reality. We're looking at exactly how your own data is weaponized against you. And this isn't just some theory. We're breaking down a landmark study on Canadian Treasury auctions that finally pulls the curtain back on how the system actually works.
Okay, let's dive into this. Financial dealers essentially act as the ultimate gatekeepers. They get to legally see your trades right before they place their own bids. Now, do you think they use this data to calculate the true fundamental value of the market? Because most people say yes. They just assume this peaking helps discover the real price of an asset, making the whole market more efficient. Well, prepare to have your assumptions completely shattered.
Wrong. They literally couldn't care less about the asset's true value. They only care about your wallet. The entire system is mathematically rigged to outplay the customer. They aren't studying your data to learn something profound about the economy. No way. They're looking at it to learn exactly how to beat you.
Section 1. Dealer's Hidden Privilege, the Legal Peaking Advantage. Just listen to this quote straight from the research. Allegations of front-running, that is, utilizing customer order information to make profitable trades, are commonplace in financial news. Guys, this is absolutely not an internet conspiracy theory. This is a thoroughly documented, everyday systemic feature of the market. They're literally looking at your hand. They're taking your order flow, reading your strategy, and then using it to position themselves perfectly.
Section 2. The misunderstood motive. Why do they peak?
So we've got two main theories here. Hypothesis A, learning about fundamentals. Basically, if you bid high, they reevaluate and assume the bond is inherently more valuable. Versus hypothesis B, learning about competition. Under this theory, they don't care about the underlying worth at all. They just want to see where you bid, so they can shift their own bids just enough to crush you and their rivals. It's pure gamesmanship.
Section 3. Uncovering Canadian bonds, the battlefield. Check out the incredibly unfair rules of this setup. Step 1. The dealer puts in an early bid. Step 2. A massive customer bid is forced to route right through that exact same privileged dealer. Step 3. The dealer secretly updates their own bid right before the final deadline. Seriously, imagine playing a game of poker, but you have to show your cards to the dealer, and then you just watch the dealer swap their own cards before the flop. It's wild.
Now, what's really interesting about this slide is that specific number right there, 5 minutes. The data actually prove that if a customer waits until the final 5 minutes before the deadline, dealers rarely update their bids. And why is that? Because they literally run out of time to process the data from their stolen glance. Delaying and keeping it a secret until the very last second is the customer's only real defense.
Section 4. The guaranteed profit logic. The smoking gun.
And this brilliantly illustrates the brutal reality of it all. We see a parallel shift where a dealer's original bid just instantly drops after observing a customer's bid. The overall shape doesn't change. They aren't changing their minds on the actual value of the asset. They're just deliberately lowering their price by a tiny margin to perfectly squeeze out the customer.
The estimated marginal values show that the dealer's fundamental valuation remained completely identical. The data points overlap perfectly. It mathematically proves hypothesis B. The fundamentals didn't change one single bit. Zero. The researchers definitively proved that dealers are purely 100% just gaming the competition.
So, the crucial point is this absolute gut punch of a statistic, 13 to 27%. That is the massive chunk of the dealer's total expected profits that comes entirely from this legal peaking. Think about that. Over a quarter of their profit doesn't come from being smarter. It doesn't come from better financial analysis. It comes purely from looking at your data and adjusting their bids to outplay you.
Let's put a hard emotional cash number on that percentage. 1.35 million Canadian dollars. That is the exact annual cash value of this unfair advantage for a single dealer in just one single market. It's guaranteed money extracted right out of the pockets of the very customers they're supposed to be servicing.
Section 5. The perfect research's blind spot, a flaw in the matrix.
Let's move to and see how this builds. The breakthrough here is honestly massive. It's the very first empirical proof that dealers only care about gaming the competition, and it actually quantified the exact millions being extracted. But notice the glaring blind spot. They completely failed to test if dealers learn from other dealers, and even worse, they cannot calculate what this market would actually look like if we stripped away these privileges. We know exactly what they take, but we have absolutely no idea how much better a genuinely fair market would be.
Which leaves us staring at this profound, really uncomfortable question. If a major financial market is fundamentally built on a system of legal peaking, a system mathematically guaranteeing dealers up to a 27% profit boost simply by looking at your data, is the game actually fair? Or are you just showing up to a casino where the house already knows your cards? Think about that for a minute. I'll catch you in the next explainer.